I'm not suggesting, Julia, that people should go out and look for catastrophe and, having found it, curl up in the corner in fetal position and do nothing. All I am suggesting is that people begin to construct their portfolio in a way that ensures them against contingency. That's all I'm suggesting. And I think that the events of last week likely make your audience a fertile resting place for that admonition.
Rick Rule, President and CEO of Rule Investment Media, and also co-founder of Battle Bank and someone with more than 50 years of investing experience. It is so great to welcome you back on the show. Rick, I cannot believe it's been a year since we've had you. There's so much happening. I'm just thrilled to have you on today. Thank you so much for taking the time.
I'm pleased to be back. I thought you were discriminating against old men and my feelings were hurt.
That's so not true. I feel like maybe we should set a more frequent cadence and get you on quarterly, every 6 months, whatever you're willing to give us. We are more than happy to have you on. We always love having you on this channel. And you were also one of my earlier guests back in the early days. So, Rick, let's start where we always start with our guest. And that is with the big picture, that macro view, that framework in which you're looking at the world today. So what is the macro picture for you today? And Rick, as you know, take all the time you need to set the table when it comes to the macro picture.
Julie, we've had a little wake-up call over the last week. And I think these wake-up calls are very useful and, in fact, wholly beneficial, although they're painful. The unwinding of the Japanese carry trade has been baked into the market for 30 years. But because it didn't happen until it didn't happen, nobody cared much. The idea that Japan could run up very large current account deficits while still manipulating the interest rate lower and could deliberately manipulate their currency lower to increase exports gave rise to a circumstance where big Japanese banks could borrow money at a very low cost in a currency that was guaranteed to go down and reinvest that money at higher interest rates in a currency that, at least relative to theirs, would go up. That can't last, nor can government debt at 300% of GDP last. But because it went on for so long, because there were 3 decades of built-up savings in Japan, people didn't pay attention to the warning signs until the trap was sprung. This happens again and again and again. It has been said there's only 7 basic lessons of investing. The difficulty is that you need to relearn all of them in sequence once a decade. And so I think it's important that people look at the events of last week and understand how forecastable they were, and understand that there are other lessons in the market too that we don't pay attention to until we have experienced them. And that is very useful.
That is such an interesting point. I feel like I've had some folks on this channel kind of mention Japan being a bit of a canary in the coal mine. Do you see it as that way? Is it more emblematic of the broader risks out there? Just curious, how do you think about Japan?
I think yes and yes.
Okay.
When people look at the U.S. economy, they say, well, why should American debt to GDP at 120% be problematic? The Japanese ran for a long time, over 200. It went on until it didn't. The Japanese individuals had much higher per capita savings than the Americans do, and hence they could afford to be stupid for longer. But when the string plays out, the string plays out. Julia, I remember, and you'll understand where I'm going with this in a while, being not unsophisticated financially myself, driving 20 years ago, and seeing a big billboard on my right, on the right of the freeway, that said, borrow 125% of the value of your home. Bad credit, okay. And I remember as a lender thinking, I'm not sure this works out okay. But I didn't correlate that complacency with the crash of 2008, although they were directly correlated. It turns out that people don't pay too much attention to warning signs that are statistical until the trap has already been sprung. I'm not suggesting, Julia, that people should go out and look for catastrophe and, having found it, curl up in the corner in fetal position and do nothing. All I am suggesting is that people begin to construct their portfolio in a way that ensures them against contingency. That's all I'm suggesting.
Mm-hmm.
And I think that the events of last week likely make your audience a fertile resting place for that admonition.
You know what? You're right. This is interesting though, like these warning signs out there, being prepared for that contingency. Rick, what for you are the warning signs? What are you most paying attention to right now? Maybe things that aren't getting discussed enough.
2 risks and 1 opportunity. The risk is the fact that most people believe that they enjoy a real yield on US dollar denominated deposits. When people in the United States look at inflation, and when people in other countries look at US inflation, they rely on the CPI. The slogan for that is that it's the CP lie. It doesn't measure the deterioration of the purchasing power in US dollars. It doesn't include, as an example, food or fuel. Julia, if you look at me, you can see that I like to eat. So an inflation index that doesn't include food is of very little use to me. But more importantly, it doesn't take into account tax, the largest household expense of most working households in the United States. When I calculate the increase in the price of the goods and services that I use to live, including government, which is neither a good or a service, what I see is that the purchasing power of my earnings and my savings is declining at 7.5% compounded a year, not 2.6. If I juxtapose that with the yield available on my savings in the U.S. 10-year Treasury at 4.3, rather than earning the delta between 4.3 and 2.6 as a real yield, I'm losing the delta between 7.5 and 4.4. And what that means to me is that the natural direction of interest rates is higher, or the natural direction of equity prices is lower, and that people need to pay attention to that. Mm-hmm. That's, I think, really the first thing that I look at. The other is related to it. It's the inexorable increase in government debt. People don't react to government debt because it doesn't affect them until it does. The financial crisis of 2008 was solvable by the federal government because there was faith in the federal government, and there was faith in the federal government having the firepower to extinguish the problem. On-balance sheet liabilities of the U.S. government in 2008 were about 25% of GDP. On-balance sheet liabilities of the U.S. federal government now are 120% of GDP, almost 5 times higher. That is concerning. It doesn't concern most people because they're more attracted to narrative than arithmetic. But people need to pay attention to arithmetic. Even more challenging for me, though, Julia, is the incredible expansion of the net present value of unfunded liabilities in the United States, entitlements. The Congressional Budget Office estimates that over $100 trillion in promised entitlements, Medicare, Medicaid, federal pensions, military pensions, exists today, which means that we're $100 trillion net present value behind the 8 ball. And nobody pays attention to this. We're trying to service $35 trillion in on-balance sheet liabilities and $100 trillion in off-balance sheet liabilities with a budget that is itself in deficit $2.5 trillion a year. We don't care because the trap hasn't been sprung. The Japanese didn't care until last week.
All right. So do you think there will be a point when we do care? Like we have to care at some point.
We absolutely have to care. People your age who believe, who are counting on Medicare, Medicaid, Social Security, if they're government workers, their pensions, need to understand that past is not prologue. They may deserve it, they may want it, but they're not going to get it. they need to take care of themselves because society is going to be unable to afford to take care of them.
Right.
Whether or not they experience it in 2024, 2025, or 2026, they are going to experience it. Even people my age need to understand that although they may believe that they're entitled to entitlements, that we're coming to a point in time very soon where they won't be affordable. How will they deal with it? Well, they will certainly raise the qualifying age. They have to do it. When Social Security was instituted, the average life expectancy of an American male was 66 years. And Social Security covered you after age 65. There was a 1-year liability. No longer the case. They'll have to means test it.
Yeah.
Which is to say, rich people like me need to understand that they're going to pay in a lot more than they're going to get out, and they're going to be mad about it.
But isn't it kind of silly? Like someone like Warren Buffett, if he got like a Social Security check, like it's a little like, really?
Yeah, absolutely. Now,
Yeah.
the way that's sold is that it's insurance.
Mm-hmm.
That's wrong. It's theft.
It's kind of generational theft too. Like if we're paying for it.
It's absolutely counter-generational, and your generation should be pissed.
Yeah.
My generation voted themselves all these cool benefits, but we forgot to pay for them.
Mm-hmm.
So we get all the cool stuff, and you all get the bill.
Look, I love the boomers, but it's kind of like, yeah.
Well, we make a lot of noise about the fact that we're leaving you guys between 140 and 150 trillion dollars worth of investment assets.
Mm-hmm.
And we ignore the fact that we're leaving you $135 trillion in liabilities.
Yeah, the liability side of it.
Correct.
Yeah. Mm.
So, and I'm not saying that people curl up in the corner in fetal position and think about this. I'm just saying that they think about it.
Yeah.
I think the third thing that I want to leave people with is on the opportunity side.
Mm-hmm.
Traditionally, during periods of time when investors have come to be concerned about the maintenance of purchasing power in conventional assets, particularly bonds, but also equities, the primary beneficiary has been gold. Gold is under-owned. Less than 0.5% of the savings and investment assets in the United States are comprised of gold and gold-related securities. The 4-decade mean market share of precious metals is 2%. If interest in gold merely reverts to mean, demand for precious metals and precious metals-related assets grows fourfold. If you juxtapose my warning, which is that we're suffering a negative real yield, and that negative real yield increases as government obligations increase, where traditionally the biggest beneficiary of that disconnect is gold, and where gold is substantially under-owned, I think that there is a probability rather than a possibility of a return to mean. I have no idea what would happen to the gold price or the price of gold shares if you increase demand for them fourfold. But I have a feeling I might find out, and it will be at the very least interesting, and I suspect for me, pleasant.
So do you look at owning gold as more like that's the insuring against those contingencies? That is the wealth preservation. Like, how do you think about it?
Exactly.
Mm-hmm.
When people from your show talk to me and they say, well, when is the gold price going to move? I say 2000. In the year 2000, it was $253 an ounce. Now it's $2,400 an ounce. It's increased at 8.4 or 8.5% compounded for 24 years. So when is gold going to move? 24 years ago. Mm-hmm. People are looking for quantum increases in gold. The type of increases in gold that they got in the period 1970, 1980, or 2000 to 2011. I think we might see those too. But that's not why I own gold. That's why I own gold shares. I own gold because I believe that gold is a great form of liquidity. It's insurance against collective stupidity. And collective stupidity is in great abundance.
That's a great line. Insurance against collective stupidity. I love that line. My audience is going to love just what you're saying too. Can I go back and ask you something? I've been taking a lot of notes, and I don't mean to like skip around, but there's something I just want to go back to in the conversation, if you don't mind.
Please.
When you were talking about like, I guess it's like we were talking about the CPI, and how it excludes like certain components, and it doesn't take into account tax, which is the largest expense. Can you help me understand the tax component of it? I know that's kind of my naive question, but I am curious about that part of the equation.
The CPI is an index that tracks the price of goods and services that the big thinkers of the world believe that the average household consumes. Mm-hmm. But they exclude the price of government. Now, Julia, if I didn't have to pay the tax, I'd bitch a bit less about the index. But the truth is that the average North American household, Canadian and American, directly or indirectly, loses 43% of their household budget to tax.
Mm-hmm. Yeah, that's true.
The idea that a cost of living doesn't include tax is absolutely silly to me. And government is consuming 43% of our income, despite the fact that between on-balance sheet and off-balance sheet liabilities of the government, they are 5 times GDP. That is to say, they're financing a bunch of it. And it still consumes 43% of income. The idea that somebody constructs a household budget without including tax assumes that person is very stupid. But the people who generate the CPI are people who are constructing a model household budget while leaving out 43% of household expenditures. How can they do that?
Let me ask you a follow-on then, like for the inflation problem that's been quite persistent, could they solve it like with maybe lowering taxes for folks? Or I don't know, like do you have a perspective on like tax policy or what would be some smart tax policy to enact?
I think that they have to lower expenditure. Mm-hmm. Lowering tax without lowering expenditure, which is what Reagan did, has a word for it in English. It's called fraud.
So you were not a fan of Reaganomics?
I was a fan of the idea. Mm-hmm. The idea of Reagan was that you would roll back government.
Got it.
There was a wonderful book called The Triumph of Politics by David Stockman, mm-hmm. Reagan's director of management and budget. He said that the Reagan Revolution lasted 90 days before it was ambushed by reality. You control inflation by living within your means. And most voters and most consumers don't have any particular interest in that. You control inflation by employing enough capital in the economy to lower the real price of goods and services. You focus on investment, not consumption. Very, very difficult thing to do. The natural trend in the economy with increases in productivity due to technology is for prices to go lower. But there seems to be no improvement in efficiency that we can't out-consume. People, it would seem, would rather live rich than be rich.
That's an interesting point, too. Like, you're getting at, like, individual responsibility then.
I am.
Yeah.
For myself, I've run a thought exercise for a very long time where I balance my consumption of goods and services once in US dollar terms and another time in gold terms. And when I look at the price I pay for gasoline at the pump or the groceries that I buy at the store, and I think of it in the context of $250 gold, stuff feels very, very cheap to me. When I look at the basket of goods and services other than tax that I consume and I price them in gold at my acquisition cost in the year 2000, I think, boy, price levels have fallen. When I think of it in US dollars, I have a very different circumstance. And that just tells me that a more valid method for pricing is pricing in a constant that can't be politically manipulated, which is to say pricing in gold.
Okay, let me ask you about the Federal Reserve, because we're having a conversation about inflation, their fight against inflation. And then like more recently, gosh, in the last couple of weeks, there's been chatter around like a September rate cut. You probably saw yesterday, Monday, the mayhem we saw in the markets, a lot of chatter on X, for example, of like maybe there's an intermediate rate cut or emergency rate cut. Can I just kind of get your view of the Federal Reserve, maybe a bit more broadly? And then I would be curious, like, what do you think about the upcoming September meeting? Do you think that we will see a rate cut? Is that something that could play out?
Because I'm fairly vociferous and because I have a banking organization, I talk to a lot of lower level people at the Fed. And I have to say, despite my general anti-government bias, I found I like them, despite myself, but I've had some great conversations. The bias within the Fed as an institution is not to cut rates. The bias of the Fed is that the only institution that stands between us and the rapid deterioration of the US dollar is the Fed. They see no fiscal leadership in Congress. And the institutional bias is not to cut interest rates because they see inflation as a much more persistent problem than Congress does. The top of the Fed is very political. They don't see their customer as the U.S. citizen. They see their customer as Congress. I believe that the real rate of deterioration of purchasing power in U.S. dollars is 7.5%. And I believe that savers deserve a bonus on top of the deterioration of the purchasing power of their savings. So I suspect if the market were left to its own devices, that the interest rate would be 7.5% plus 2 or 2.5%, which is to say 10%. I don't think the market likes that. Now, people want affordable housing, Julia. If you took the price of a first mortgage from its current 7% to 7% plus 2% plus 1.5%, and you had a first mortgage rate at 11.5%, you would have affordable housing. It's just that people want other people's houses to be affordable, not their houses.
Yeah.
I believe in real interest rates. I think the right thing for the Fed to do would be to disband. I don't believe that manipulating interest rates is healthy. Now, manipulating interest rates is very healthy for an old, fat, bald, rich, smart guy like me. When you manipulate interest rates, you steal money from savers. You pay them less than you otherwise would for their savings. And you make those savings available at a discount to people like me who have access to credit and the experience to use it. Artificially low interest rates over the last 40 years have been an enormous subsidy to people like me who didn't need it, at the expense of working people who prudently saved for their retirement and found that the capital that they saved as a consequence of artificially low interest rates and inflation was insufficient to serve them in retirement. Mm-hmm. Artificially low interest rates stole from savers and subsidized spenders and subsidized investors. So for all of you who saved blindly, believing in lower interest rates, thank you for what you did for my net worth.
Do you think the pendulum could swing, though, back? Like, it sounds like it's been like a war against savers. Do you think that could swing back?
I don't know. The last time that the Fed gave a treasury auction where there was insufficient attendance was in the Clinton years. They had something called the bond vigilantes.
Yes.
Capital markets now have come to believe in manipulation. We, as investors, insurance company investors, stuff like that, we've learned to leave long bonds to the collective. We've learned to let other people buy that stuff. And we've learned to leave them with the risks while we invested money in instruments that would make money from the debasement of the currency. Whether or not the investor class and the political class will allow markets to work to put the society on a more even footing remains to be seen. The readjustment from fraud to fact would be very difficult for people to get used to. and whether or not we have the will to take the pain while the pain is manageable, or postpone the pain to the point in time where it becomes like the unwinding of the Japanese carry trade, catastrophic, remains to be seen.
Rick, could you elaborate a bit more on the readjustment from fraud to fact?
Well, let's assume for a while that the rate in escalation in the price of goods and services continues unabated, meaning that the purchasing power of the US dollar continues to decline at 7.5% compounded. And let's say, too, that we continue to add to the on-balance sheet and off-balance sheet liabilities of the U.S. government, which is to say we continue to inflate our liabilities by 7% compounded, which is what we're doing now. The accretion in on-balance sheet liabilities, which is to say the bonds, and off-balance sheet liabilities, which is to say entitlements, is increasing at 7% compounded. At some point in time, we have to deal with that. We dealt with it in the 1970s by debasing the purchasing power of the US dollar. That was the first way that we made Social Security affordable. We promised people a certain dollar level of benefit, and we devalued the purchasing power of the dollar by 80% over 10 years. It was a wonderful piece of fraud. We got away with it. And I think we're probably going to do it again. The way that you deal with $100 trillion in unfunded liabilities is you make $100 trillion worth $20 trillion via inflation. I think we do that. What it means is that a bunch of people who hope to maintain their current standard of living with entitlements will find themselves sorely, sorely disappointed. I think that the second thing that we do is that we find the level of services that we've come to expect to be unusually high. And we need to deal with our expectation. As an example, as I said earlier, when Social Security was instituted in the FDR days, Social Security existed to maintain a person at a barely post-poverty level from age 65 on. And the average life expectancy of an American male was 66 years. The average life expectancy of an American female was 68 years. These were affordable insurance programs. The average life expectancy of an American male now is 82 or 83, an American female, 85. We've lowered the qualifying age to 62, and we've included people with disabilities. We need to change our qualification assumptions, which is going to be very hard on people who expect to receive a benefit that there is no money there to pay for. So we will at once raise the retirement age. We will reduce the benefits, and we will inflate away the net present value that the benefit buys. We will do all of the above. And that adjustment is going to be hard for people who haven't paid attention to the arithmetic. When I say things like this on shows like yours, I get emails from people saying, I have paid into Social Security for 35 years. I've done my bit. I deserve it. They don't realize that the money's been stolen. The money's been wasted. The money's gone to money heaven. A young boy or girl who's been a good boy or girl, and they put their tooth under the pillow and hope for the tooth fairy, is always disappointed to learn that there is no tooth fairy. And people who believe that our society is going to be able to afford $130 trillion in recourse liabilities, which is increasing by 6 or 7.5% compounded, people who believe that to be mathematically sound need to review what happened last week. last week is a logical consequence of not understanding arithmetic.
Yeah. I got to say, Rick, you are a quote machine too. And I love, I'm like, my notes are filling up here. And it's just so incredible listening to you, learning from you. I have another question for you. I kind of sometimes I think of you as a bit of like a credit analyst, or at least you have that lens. So I am curious to get your take on just what's been happening in the bond market with the 10-year falling below 4. I'm curious, like, what your take is there.
Well, I think it was Franz Pick that said the long bond is a certificate of guaranteed confiscation. The period that we lived through, 1982 to 2022, was the most benign period in human history. The nominal interest rate fell for 20 years, and people actually bought bonds for capital gains as opposed to preservation of income. Think about a bond yielding 10, or think about a bond, yielding 4, in a currency where the purchasing power is declining at 7.5. That's truly ugly. I mean, the arithmetic around the U.S. 10-year means that the U.S. government will deprive you of 3% of your purchasing power every year for 10 years. The first government promise of my life that I'm certain that they will keep. They will make me 3% less rich every year for 10 years. They will do that. That's not a promise which is attractive to me, Julia. But that doesn't scare me as much as the junk bond market. If you ask me what really keeps me up at night, it's the fact that tens of millions of Americans are yield junkies, yield whores. They have bought ETFs where the primary asset is below investment grade bonds, not understanding anything about the credit quality of the bonds, not understanding anything about the debt covenants of the bonds, buying them for yield. The ETFs are extremely liquid. There's trillions of dollars in those ETFs, and they trade billions of dollars a day. But the assets in the ETFs are extremely illiquid. These junk bonds trade over the counter. In a liquid ETF, if there becomes broad spread concern about credit quality, and Ma and Pa investor begin to be concerned about below investment grade bond defaults, which they should be, and they begin to sell the ETF manager must sell the underlying bonds to redeem the ETF. And then, Julia, we have what I called in my youth an owl bond. An owl bond is when you call the broker and say, sell the bond, and he or she says, to who? To who? This highly liquid superstructure with a very illiquid infrastructure, a run on the bank where there is no FDIC, is what really scares me.
How, like, okay, so like, if you had to give that like a prop, like that risk, if that's keeping you up at night, like,
I don't think about it.
Okay.
There's no way to quantify it.
Yeah.
This income-oriented ETF is a monster of the last 30 years making. It isn't a problem I understand how to solve. I mean, the way I solve it is I structure my own bonds. I make private loans, sometimes to public companies. I don't own high-yield ETFs. I actually have a shopping list of oil and gas junk bonds that I would buy if the ETFs had to sell them. In other words, I'll play the game two ways. I'll try and stay out of the mayhem if that market falls apart. But there are some assets in that maelstrom that I would like to own at the right price. I remember in the early 1990s when the oil market fell apart and the bond market fell apart, that I could buy below investment grade oil and gas company bonds, particularly in Canada, 5-year bonds at 30 or 40, bonds where the face yield was 12%. The running yield, because I bought them at 40, was 16%, and where the yield to maturity was at 25% or 30%. This was the best of all possible worlds, but that was because I had done work on the company. I understood the underlying bonds. I understood the covenants. And most of the people the Mas and Pas who are buying these high yield ETFs just looked at the difference between a 5.9% yield and a 4.7% yield and forgot about risk. And I'm
Got it.
afraid they're going to pay an ugly price for that.
Yeah. And you operate like in that natural resources, like that is your circle of competence too. And like, sounds like you would be ready to buy when the time presents itself. Okay. Before we start to wrap here, I want to get your take. I mean, I don't know what you're willing to share. I know you're a libertarian, but I am curious, like, also, I think you're Canadian, right?
I'm American. I went to university in Canada.
Why did I think Canadian for some reason?
I frequently comment on Canadian policy issues. I only criticize governments where I pay tax.
Okay,
and
got it.
sadly, I pay tax in Canada.
Okay, gotcha. I understand. All right. So my question for you is, how are you thinking about the upcoming election and the scenarios that could play out and what that, I'm just specifically curious from more of like an investor perspective, maybe more of the economy, markets, policy that would be relevant like to this audience. How are you thinking about it?
No good outcomes.
Okay.
I think Mr. Trump would, in the near term, be good for the equities markets. But I say in the near term. I'm afraid, and this will cost me whatever prestige I have with your viewers that is left. It'll cost me that prestige.
No.
But I will not vote for any of the three stooges. I will not vote for Trump. I will not vote for Biden. I will not vote for Kennedy. I think that a superstructure where somebody like me consigns responsibility for their future to any of Trump, Biden, or Kennedy is unconscionable. I haven't heard any of them asking me to take more responsibility for my future. I haven't heard of any of them who proposes to reduce the deficit. I haven't heard any of them that proposes to reduce meaningfully government spending or debt. I'm reminded of H.L. Mencken, who said, the voter generally gets what he or she wants, usually good and hard. Mencken, too, described elections, I think it was Mencken, as advanced auctions of stolen property. That's how I regard the upcoming election, and some of that property is mine.
Okay, let me ask you this, because you mentioned like these are important topics that have come up on this show, reducing the deficit, government spending, our debt situation. Do you think like we'll ever see a candidate like run on that platform, and could they be successful, or like people just like too self-interested and they wouldn't be willing to make some like hard decisions, hard sacrifices? I am curious like the feasibility of it.
We had a dramatic turn in 1980 where President Reagan came in and challenged the status quo. But the Republican backers didn't want to see their own oxen gored. They wanted to see everybody else sacrifice and not them. The consequence was well described in The Triumph of Politics by David Stockman. I believe that it will take some period of disquiet, like we experienced in the decade of the 1970s. You weren't around then, Julia. You were unborn.
That's true.
In the 1970s. But it was interesting. Social turmoil, literally riots in the streets, incredible polarization, not just right and left, racial polarization, worse than the racial polarization that you see today. A decline in living standards that saw more than 80% of the purchasing power of wages and salaries. The consequence was, at the end of the decade of the 1970s, we were willing to vote for lower government. The government that we voted for was one that we thought would lower other people's living standards relative to our own. But we were willing to allow Volcker to raise interest rates from 5.5 to 21%, which broke the back of speculation and broke the back of inflation. It took a crisis to cause us to do the right thing. The recovery that we got by doing the right thing was prompt enough inside a year and a half or 2 years that we didn't follow through. We didn't slay the beast. We didn't make Reagan follow through on his promise to truly reform Social Security, to truly reform Medicare, truly reform Medicaid, to cut the size of government. We allowed him to get away with only cutting the growth of government. We allowed him, too, to finance the change by increasing the debt, which is to say we transferred the tax burden from current payers who got a tax cut to future taxpayers who were burdened with the debt that we enjoy, if that's the right phrase, today.
Yeah. Okay. I have to say, Rick, awesome to have you back on. Love listening to you. Could listen to you for much, much longer. I want to give you the final few minutes here to do a couple of things. I would love for you to leave the audience with some parting thoughts, something to think about. It could be something you want to reinforce from this conversation, or maybe it's something that I missed in this interview. I also want you to share where folks can learn more about your work. If you want to share anything like that you're doing, they can follow you on social media. I do know that you have a boot camp coming up on, I believe, August 24th. Would love for you to share that as well. Right. But the final, 5 minutes or so, they are all yours. The floor is yours. Take it away.
Several things, particularly young people. Invest in yourself. Read 4 books. Economics in One Lesson by Hazlitt. The Intelligent Investor by Ben Graham. When you've suffered through The Intelligent Investor, Securities Analysis, also by Ben Graham. If you follow securities analysis, actually follow it, not just read it, you will become rich, not might become rich. And finally, if you have the patience, read Human Action, about the way people work, not the way other books tell you it should work. And then after you've invested in yourself, invest. You can't become a capitalist without capital. If your money doesn't work for you, you will not be able to sustain yourself in the future, because society is going to be unable to sustain you. You are going to have to sustain yourself and defend yourself from society. That's important. If you care about natural resources, go to Rural Investment Media. At Rural Classroom, part of Rural Investment Media, there are 200 hours of instructional programming for the best possible price, free. If you want to personalize it, go to Rural Investment Media and list your natural resource stocks. I personally, for free, will evaluate them. 1 is best, 10 is worst. And I'll comment on individual issues where I think my comments might have value. Finally, if for any reason you're unhappy with your current bank, check out mine, Battle Bank. Either at battlebank.com or at Rural Investment Media. Just write banking. And for those of you who are accredited investors, for those of you who can participate in private placements, on August 24th, the Rural Classroom will do an 8-hour-long deep dive into private placements. This is not entertainment programming. This is hard, dense, fast-paced curriculum. You'll have access to the recordings for a year. You'll need them. We will give you more information about private placements than you ever knew you needed. Private company private placements, pre-public private placements, public investment in private equity, importantly, debt private placements, a very fertile and very overlooked part of the private placement market. But understand, this product is only for people who can afford the risk and the work in private placements, and people who want to be able to work for themselves, people who are willing to subject themselves to 8 hours of hectoring from an old green eye shade guy and his cohorts. You'll find more information at Rule Symposiums, or probably, Julia, a link.
I'll leave a link in the show notes. Yeah.
Fantastic. This will be a wonderful opportunity for people who care. We've done boot camps on uranium, boot camps on silver. It's important to note that all of our investment products, the boot camps and our conferences, come with full ironclad money-back guarantees. If you don't think you got your money's worth, even if the fault is yours because you were unprepared, email us. We'll give you the money back. The financial risk is all ours.
Rick Rule, CEO and president of Rural Investment Media and co-founder of Battle Bank. I just want to say thank you so much for being so generous with your time, your ideas, all of your knowledge and wisdom, and all of those great quotes. You are quite the quote machine. I had so much fun having you back on the show. Would love to get you on more often. Let's not wait a year until you come back. I really appreciate you. Thanks again, Rick.
set it up with Callie. I'm available anytime. I enjoy the process and I enjoy your audience. Thank you.
Likewise. Thanks, Rick.